So, how do we define a business? A business has some characteristics. It obtains financing from the marketplace, it uses some funds to buy assets, it operates the assets to provide goods or services, and it sells the goods or services to create revenue. So, the business needs to be financially viable and they need to build revenue, or they need to generate revenue to pay their expenses, to pay their costs. In order to form a business, you need to choose a legal form, and that can be of two types, whether you borrow money to raise capital or you have physical assets, and you need to know which ones is needed. So, what is the difference between a business and a pure charity? A pure charity is more like um, American Heart Association, for example. They don't sell goods and services, but they solicit contributions and use them to offer free services. Government agencies, they fund by taxing populations. So yes, there is a difference between a business and a pure charity because business has to sell goods and services either in the form of products or patient care, but they don't only solicit contributions, whereas a pure charity only solicits contributions and use them to offer free services. The primary role of finance within any organization is to plan for, acquire, and utilize resources to maximize the efficiency and the value of the enterprise. So, there are some finance activities, for example, planning and budgeting. In planning and budgeting, you will evaluate financial effectiveness of current operations and you will plan and budget for the future. Financial reporting, you will prepare financial statements, for example, the profit and loss statement or the earnings and revenue statement. Capital investment decisions, you will be acquiring land, buildings, equipment, and it is the primary way by which businesses implement strategic plans. They find out the locations and so forth. In financing decisions, uh, you need to raise capital to buy assets, so it can be a debt versus equity capital, long term or short term versus the short term debt. Contract management. Healthcare organizations, they negotiate, sign, and monitor contracts with insurers and managed care organizations, and that is really contract management. Now, finance activities listed on the previous slide, there's four C's to summarize them. So you need to minimize cost as much as possible. You need to make sure that you don't have a lot of expenses. You don't buy too expensive things and then are not able to pay for it. So, for example, profit is basically revenues minus expenses. And if you have a high amount of expenses, then and if you don't have enough revenues, for example, then you will have less amount of profit. Cash sufficiency is very important also because cash is a lubricant by which the wheels of the organization run smoothly, and you want to make sure that you have enough cash for the organization to run. You also need to make sure that the cash conversion process is there and that's sort of quicker. I have a paper published on this topic. It's called the cash conversion cycle or the CCC. You want the cash conversion cycle to be short. You want it to be as short as possible because that means that that outstanding debt that there is, people owe you some money and they need to pay you, and if they have to pay you they better pay it fast so that you can have the cash, the lubricating oil through which your organization will run. Capital access is basically you need to have the funds to acquire land, building, or equipment if you need it. And cash control is the control mechanism of control to ensure that capital is wisely employed. You don't need to be buying land or buying equipment just left and right. For example, let's say there is no need, but you have like 10 MRI equipments at your facility, thinking that it may be used, but you should buy it only when you need it. So the control of financial resources is talking about that. Now the next is the structure of the financial department. So at large providers such as big hospitals, the finance department is usually organized as follows. There is this chief financial officer and they have a controller and a treasurer. The controller is responsible for accounting, budgeting, and reporting activities. They also do routine budgeting, preparation of financial statements, payables management, and patient accounts management. Now, the treasurer is more concerned about acquisition and employment of capital, debt management, financial risk management, lease financing, and so on.